My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make a little money. My job is not just to entertain, but to teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. This was one of those days where unexpectedly it all came together for the bulls. Dow advancing 47 points, S&P gained 0.52%, but the Nasdaq jumped 0.9%. With today's strength, it's important to note that the Nasdaq and the S&P both finished the month of February at record highs, something I regard as quite simply amazing, given all the woe and worry that we endlessly hear about. What fueled today's rally? Well, it's actually a complex formula of emotion and empirical data where a widespread sense of negativity gets proven wrong, and a remembrance of why we like stocks shines brightly, smashing the all-encompassing gloom.
House of pleasure.
Let's start with the setup. We get a lot of data from all sorts of places, don't we? The Census Bureau, Bureau of Labor Statistics, Federal Reserve Bank of St. Louis, S&P Global, the Commerce Department, and so many of these things, and your eyes just glaze over. Often these figures really don't mean a hill of beans. But periodically, when the Fed is in play, they can mean everything, especially if you know that the Fed cares about some pieces of data more than others. Right now, the Fed is very much in play. We've been getting some hot economic data of late, suggesting that they don't have much reason to cut interest rates, which is unfortunate because rate cuts are like oxygen for the bulls. Fortunately, there are numbers that can counteract the no-rate cut scenario. And, for example, today, we got a cooler-than-expected U.S. personal consumption expenditures number from the Bureau of Economic Analysis in the Commerce Department. Now, I know that sounds like authentic Wall Street gibberish, but this number is the Fed's favorite gauge of inflation, and it came in right. Going into this personal consumption expenditures reading, or PCE, we had a bunch of wayward days where the market was basically doing nothing because traders didn't want to get caught. They didn't want to react to anything, given that this number was waiting in the wings. This morning, at the ridiculous hours that I get up, I'm watching CNBC, and you can see the S&P 500 futures going down, 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 based on nothing. Maybe fear? We didn't have anything of import last night. The negativity coursed through both the stock and then the much larger bond market. Everything's selling off with real intensity as the morning marched on. Again, no particular reason other than fear. And then at 8:30 a.m., we get the Hallow PCE report, and frankly, it was perfect.
House of pleasure.
Not too hot, not too cold, just right. Up just 2.8% year over year. Fed likes that number. Bond yields fell. S&P futures reversed, and the bears were completely picked off, leading the wrong way. Now, if the S&P 500 futures had been up ahead of this number that the Fed regards as all important, it wouldn't have mattered, right? We wouldn't have had a big gain. Good, but we were down because there was so much negativity, and that made all the difference. If you're bullish, you live for days like this one, where all the supposedly genius short sellers need to either undo their bets or get stampeded. Do you know what the biggest negative bet is in this market? Think about it. Do you know what the self-prescribed bubble bears have been waging war against, telling you that it's all phony hokum? Yeah, artificial intelligence, that's what. We've seen stocks flying up on hopes of AI for months now, but lately it kind of felt like they were topping out, didn't it? Lots of stocks have been doing just okay in the last few days, and we did have that excellent NVIDIA number last Wednesday. However, on Wall Street, 8 days is a long time ago, and we haven't had any new data points since then. I kept hearing that the NVIDIA quarter marked the peak of the AI craze. So put yourself into the heads of these wise guy professionals. First, they think they're going to win on this inflation number that's Toto for the bulls. Toto meaning turn off the oxygen. Wrong. Second, they feel like with a little bit of pushing, maybe today could be the beginning of the end of the AI bubble. Pop! For that to happen, though, we need some AI disappointment, some tech negativity. These things don't roll over in a vacuum, do they? Now, there was a moment last night where the bears felt incredibly emboldened. Snowflake reported, and if you watched last night's show, you know the company gave you a pretty darn disappointing outlook. At the same time, Salesforce, a Dow component, gave you a forecast that was a couple of percentage points light of what the bulls were expecting. And people were saying, hey, you know what? That was wrong, too. Okay, Snowflake was indeed disconcerting, but a close reading of the Salesforce conference call told you that companies are hiring Salesforce like mad. Hey, look, and if you heard Mark Benioff on the show, you would have known that. The data cloud that they have helps enterprises use their data to improve sales, and it's racking up extraordinary numbers. CEO Mark Benioff said this is the best it's ever been for the company in one particular cloud that they're offering. It's a virtual explosion of spending on AI. Mark joins Bill McDermott from ServiceNow and talking about how big this AI opportunity is, not in the future, right now. Actual numbers. That's right, actual numbers, not pie in the sky. So a stock that was down 15 points on its outlook actually climbs out of a hole after the conference call, and while it retreats at the opening today, then blasts off during the day and finishes up 3%, taking a lot of stocks with it. Then this morning, like a lightning bolt, we get a report from the usually tempered analyst, old hand vet Chris Danley from Citi, who threw a grenade into the Bears den with a note that says, still wildly bullish on semis. I mean, Danley blew the Bears to smithereens. He loves the AI thesis. That's terrific because next week, HP, the old Hewlett Packard, will have NVIDIA's Jensen Huang on stage, AMD's Lisa Su, ouch, only virtually, talking about the new artificial intelligence PC that HP's been talking about endlessly and I've been telling you about at last. Hey, by the way, I've told you that this is going to be a seminal thing. You'll be talking to your PC all day instead of doing work. Then to make things really interesting, Best Buy, the electronics chain, offers a fairly tepid view of things, but says that there are two standouts to watch. A Samsung phone that is full of AI that is selling well. And Meta's Ray-Bans, the ones I keep telling you about, are selling just like hotcakes. They take pictures, they take calls, they take messages. And by the way, they look like regular Ray-Bans, not as like you're like an idiot walking around town. All these tidbits combined to send up some of the now magnificent seven, well, kind of ragtag seven, Meta, Alphabet, Amazon, and of course NVIDIA, which is a given if the redoubtable Jensen Huang speaks in Vegas about PCs next week. Now, I know that there are a lot of people who are worried about the decline in the stock of Apple. I see it just as a lull that will refresh. I'm not changing my view, which is own it, don't trade it. If you listen to the CEO of Best Buy, Corey Barry, talk this morning about the red-hot Samsung phone, well, you can see the future of what Apple has to be working on. AI in your hand. What are people liking about the Samsung phone? I think a lot of things that Apple can duplicate or exceed. The circle-to-search function, offering discovery in your phone with a simple gesture. How about generative edits to transform your photos? Find the right words fast with a chat assist. And maybe the most exciting thing, live translation on a phone. Okay, I know it's a Samsung phone. But can you imagine how hard it is to get anyone to buy a Samsung phone? And it is selling. I mean, come on. If Apple can just get a beat on half of these things that for the iPhone 16, then you know it'll be an incredible upgrade cycle. You're selling Apple into perhaps the new generation of AI? Now, there were some laggards today. Of course, I get that. There are plenty of safety stocks that weren't so safe. That said, I wouldn't be surprised if the rally continues tomorrow, given that the PC and server giant Dell shot the lights out after the close today. One more data point showing that tech's got a lot more strength than people think. But the bottom line, what mattered was the 1-2 punch of an economy that's just right, meaning still potentially ripe for rate cuts. It could happen. And the fact that AI is alive and well. It reminds us why you can't leave stocks, even if you think we've had a nice run so far this year and it'd be safer to move to the sidelines. Stay long, today said, right? And you can, indeed, make more money than those bonds that beckon so many in a way too crowded trade that's not for us. Macy in Illinois. Macy.
Booyah, Jim. Here's
Booyah.
Macy.
All right, what's happening? Fill me in, Chief.
I'm 8 years old, and I love playing Roblox with my friends, and I want to know what Jim thinks about Roblox stock.
That kid's got horse sense. I mean, because I'm liking Roblox very much. I like that last quarter, and a lot of it is because the kids realize that this is a smart way to learn. I wish I had it. All we ever did was play Monopoly, and I would dump the board if I lost. Let's go to Smitty in South Carolina. Smitty.
Jimmy Chill, how are you today?
I'm chilling. What's happening?
Good. Jimmy, great meeting last week, by the way.
Thank you.
Fantastic. But, Jim, the reason for my call today is I currently own CrowdStrike. And now with Palo Alto trading a little bit less than CrowdStrike, would you recommend that I flip over to Palo Alto?
I'm not going to tell you to sell George. I mean, look, Palo Alto was brutal, I know, but we know because you obviously saw the presentation, we pushed Palo Alto very hard and made some money back. But there's no reason to sell what George has got. George is doing incredibly well. I'm speaking about George Curtis, the CEO of CrowdStrike. Let's just stay long and enjoy. Let's go to Ann in Indiana. Ann.
Hey, Jim, thanks for taking my call.
Of course.
It was a wonderful annual meeting as a club member. Really appreciate your efforts. Can't even imagine how hard you work. But calling about Kava. So I got on about a quarter of a position. I just trimmed after the parabolic move. But could you please help me figure out, if I don't get a full position on, how do I know when to just close it out and move on to the next thing?
You know you cut me to the quick. It's one of the toughest questions. The Kava quarter was brilliant. I didn't think it would be as good as it would be. I think you just stay long. You're playing small position. Let it run. That's all I can say. If it ever drops back to 40, we'll pull the trigger, but just let it run. All right, today's performance reminded us why you just can't leave stocks for the sidelines, even if you think we've had a nice run so far in 2024. Today's moves say, don't go. On Mad Money tonight, Hormel reported a quarter that was just nuts. I'm learning more about how the Planters acquisition helped drive the company's strength, and I've got to tell you, they know nothing. The sellers know nothing. Then I added a name to our charitable trust for the investing club after talking to the CEO at the JP Morgan Healthcare Conference earlier in the year. I'll reveal what it is and why I think the stock has a lot more room to run. And Sempra announced a 20% increase to its capital plan, brings $48 billion they're going to spend. I'm wondering how the money is going to spend and what's it going to mean for climate change. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.